Welcome, everyone, to our webinar covering Unidigestion's macro views. My name is Bob Michaelham, and I'm joined by two of my colleagues from our cross-asset solutions team, or CAS as we call them. Florian Yelpo, head of macro research here at Unidigestion.
Hi, everyone.
As well as Salman Beg, who's a portfolio manager on the CAS team.
Hi, everyone.
Now, before we start, I just want to quickly run through some logistics. We plan to walk through a handful of slides up on your screen, during which time you can ask questions. In order to submit those questions, please utilize the text box on your screen. We'll obviously take some time at the end of the presentation to answer as many as we can in the allotted time. And if we don't get to your presentation today, one of our distinguished business development professionals will follow up with you afterwards. Of course, if you have additional questions following the webinar, please reach out directly to your sales contact. Now, with that said, I believe the presentation should be in front of you, and we'll dig into our first topic of the day. Today, we'll talk through several positive fundamentals as well as several volatility triggers we're seeing in the market. Also, how we weigh each of them in order to form our expectations for Q4. Now, Florian, why don't we start with you?
Yeah. Well, like you said, since the end of the month of March, most equity indices have been on the rise, as shown on slide 2. That should be in front of you now. Recently, this trend has been coming with more volatility. The question our team of PM is currently asking itself is clearly the following. Basically, we expect a noisier market environment on the way to the end of 2020 between the US elections, the pandemic, the overall valuation situation as well. We can see a combo of that. We've been seeing a combo of that over the past 2-3 days. Now, the question is, can this noise derail the equity trend over Q4 that is right in front of you? Our answer for the moment is no, as we see medium-term fundamentals probably stronger than most would expect. If we go on slide 3, you will see a bit of that graphic illustration of this situation. On that slide, what you can see is a compared evolution between professional economists' forecast of GDP growth across 3 major economic zones: the US, the Eurozone, China, and our domestic growth nowcaster. So in-house macro indicators that we use in order to gauge the extent of recession risk. What we find striking is, first part of the year, they were working basically in locksteps, hand in hand. Now, since the months of May, we've seen a strong improvement across our indicators. That's very clear from the 3 charts. But what we haven't seen is basically economists' forecast catching up with that. Overall, that's what I'm about to say comes, of course, with the caveat of the currently unfolding pandemic situation. But overall, we see there too much pessimism in terms of growth, and we think Q4 should help investors getting more certain about the improving economic context.
Yeah, Florian, if you let me add to that, if we go to the next slide, we can see how analysts share the pessimistic view of economists that you were just talking about to an extent. So what we're looking at here are estimates for aggregate EBITDA growth in orange, so those are the lines in orange, versus what our nowcasters would imply based on a simple regression, and that's what's shown in blue, right? The left chart shows the figures for the S&P 500, and on the right for the Euro Stoxx 50. So we can see that for 2020, analysts expect EBITDA to contract by 20% for the S&P 500 and 37% for the Euro Stoxx versus their 2019 levels. However, as Florian talked about, our nowcasters are painting a more favorable picture. And when we look at those indicators, they would imply essentially roughly flat to slightly negative EBITDA growth for the S&P and a less dramatic 23% contraction for the Euro Stoxx. Indeed, actually, we're in the middle of Q3 2020 earnings season, And so far, the results are better than expected. And we can already see equity analysts revising up their estimates for the end of the year earnings numbers, which we think is a positive support for equity markets.
I hear you, Salman. So basically, you're expecting higher growth assets as growth gets re-rated. So I'm wondering, is that the only reason for higher growth expectations, though?
I'm going to take that one. Actually, it's only the first argument to our positioning. And it comes with a second one that's related with the overall situation in terms of inflation and rates. And that is an equally strong argument to the re-rating of growth. The key point is both short and long-term rates, in our view, shall remain lower for longer. It's a very strong statement from an asset allocation perspective. And why is that? First, there are virtually, in our opinion, very limited risk for inflation to resurface anytime soon. We've put together a perspective paper on that, if in case the audience is interested, where we explain, we detail the line of reasoning we have to state that inflation is unlikely to be the issue. If we go on slide 5, you will see illustration of that with our inflation nowcasters. These indicators are metrics we use to gauge the risk of seeing inflation surprises. By that, we mean inflation being above expectations. As you can see from the chart on the left, they remain negative. Negative means basically no or limited risk, let's say, of inflation surprises. And they've been displaying also a very limited recovery. If we were to be comparing them with a growth nowcasters or growth newscaster, actually, we would see a stronger growth recovery than the inflation recovery. Why is that? That, in our view, is a reflection of the large slack that remains in the economy. One way to see that is to investigate the graph you can see on the right-hand side. This colorful graph shows a decomposition of our inflation nowcasters and across the different factors we're looking at. Basically, the slack shows in the wage inflation data. That wage inflation data for now remains lackluster. We need that to normalize first before inflation can hit the economy. And that has a very strong consequence. It means basically low short rate for long. And that's a very strong message in our opinion. Second element, with the fantastic stimulus the world government have been deploying to fight the negative consequences of the lockdowns, just remember that the IMF is expecting about 13-14% of deficit to GDP ratio this year. It's a very big number. At this stage, basically nobody can afford higher rates. So now let's switch to the next page and you'll see why it is the case. On this page, what you have in front of you is a simulation. On this chart, you can see the simulated impact of a 1% increase of long-term rates on the debt to GDP ratio of different economies for the next 10 years. Okay. How do you read that? Basically, you can read it by saying a 1% increase in rates, so let's say in 10-year rates, means a 25% increase in the debt to GDP ratio of Japan in 10 years. Do we care about Japan from a asset allocation perspective? Not that much, but we would care a lot more about the US, for example. And in the case of the US, a 1% increase in rates would lead to an 11% increase in the debt to GDP of the United States of America. Just to put that into perspective, because it's important to keep scales of magnitude on the back of your mind, just to put that into perspective, the first fiscal stimulus in the US was about 13%, 1.3. So it's actually quite comparable. Both numbers are actually quite comparable. The way we see that, the way we see the situation is no country currently can afford higher rates, which in turn results into another growth boost that should not be discarded too fast in our view by investors. So just to sum things up, better growth than expected, first argument, lower rates for longer, both short and long term. These two arguments are, in our view, setting a very positive fundamental scene for growth assets in the medium term.
Got it. So overall core scenario is fairly positive, seeing pessimism on the recovery and then a lack of inflation pressure on yields. I mean, that seems a little bit too good to be true. What are the risks? Let's talk about the risks.
Sure, I'll jump in on this one. First, I think it's important to point out, and Florian has already mentioned it, that obviously with coronavirus cases rising, the path there is unclear to an extent. Now, there have been significant developments in treating its symptoms, and importantly, governments seem to be taking a more surgical approach to limiting the spread instead of wholesale lockdowns that we saw back in March. What we think is potentially a clear risk for the rest of the year, though, and into next year, is the restart of the U.S.-China trade war. So if we go to the next slide, we can sort of dig in on this a little bit. I think, we think that the trade war risk has really moved to the back of many investors' minds. But what this slide shows is China's progress in meeting its commitments for 2020. So just to remind everyone, as part of the phase one trade deal that led to the U.S. unwinding some of the tariffs that were implemented by the Trump administration on Chinese imports, China, for its part, committed to a set amount of purchases of U.S. goods and services, roughly $170 billion based on Chinese import statistics, or $140 billion based on U.S. export statistics. The dashed lines here on this chart just give you a simple linear extrapolation of what those yearly numbers would mean if they were prorated monthly. And then what we show in the solid line is the actual amount of China purchases, again, measured using either import data from China, that's the dark blue line, or export data from the U.S., that's the light solid blue line. As the chart shows, China is meaningfully behind its commitments. And of course, China could massively increase their exports for the rest of the year. They could claim the pandemic as a reason for failing to meet their commitments, or reach a diplomatic deal. But for now, they're really at risk of missing their phase one trade deal commitments, which would provide justification for the U.S., the Trump administration, to reimpose tariffs or other measures as we head into the fourth quarter.
Okay, so some medium-term geopolitical risks. What else, though, guys? Are those the only risks you guys are anticipating for the end of the year?
Not quite. We see actually two more risks that we think is worth discussing. The first of which I'm going to cover is the level reached by valuations broadly. If we flip to the next slide, you see a taste of that. With the rally I was mentioning, and even more so in October, up to actually the past 2 days, most equity indices are showing pricing levels that can seem to be extreme now. On this slide in front of you, on the left hand side, what you can see is price earnings ratios compared to the respective history, and the gray diamond or red diamond that you should see in front of you shows where we stand as of now. Clearly, apart from basically Chinese stocks, overall, we are now at very high levels. We are at very high Ps, simply put. We see that as a potential headwind. That's very clear to markets. It could be an accelerant in the case political risks Salman was highlighting would gain in momentum. It could also play an accelerated role in the case the pandemic starts spreading even more than today. Now, have we reached bubble-like levels? That could be the conclusion you could get from the chart on the left. And our answer is that we doubt so. We've been saying that for a couple of months now. There is a very important element that you need to factor into your assessment of how expensive, especially stocks are, which is the impact of rates. So if you look at the chart on the right-hand side, you will see our valuation metric, cross-asset metric for risk premia. And that valuation metric takes factors in the influence of rates. And once you do that, what you can see is this lower for longer rates environment we were discussing a minute ago also naturally creates an environment for higher P/E ratio. There is a long-term P negative relationship between P and rates. Lower rates implies a structurally higher price earnings ratio. As of today, our valuation indicators say that equities looks fairly valued. So the truth is probably in between the graph on the left and the graph on the right. In the perception of investor, at least valuation should be a risk now. We've seen profit-taking periods in September. That's a clear symptom of that, and that could work, like I said, as an accelerant when once combined with the risks that we are currently describing.
And if I could just jump in here, I think there's a second important point, which if we go to the next slide, we can dig into. So slide 9, which is coming up now, shows investor positioning and that positioning isn't the tailwind it used to be. So this chart is one of the ways we on the cross-asset team monitor investor positioning, in particular for different types of hedge funds, where we look at the realized beta of managers' returns to equity markets or other assets. The first point to highlight is that through most of the last quarter, positioning looked somewhat defensive or neutral on equities. This created room to support the rally, which was certainly a positive force over the summer. But today, we can see that positioning has moved meaningfully long across various equity markets, right? So you can see basically those lines with some dispersion, but basically trending upward from May until the end of September. So while positioning is rarely a trigger for a sell-off, it can act as a volatile accelerant. So from our perspective, positioning it's no longer the tailwind that it was for markets, and it's shifting more towards a headwind. And we already saw some of that over the last few weeks, where especially in some of the most crowded positions in U.S. stocks, tech stocks, in early September when we had that unwind and significant market sell-off.
Got it. So potential for a trade war, valuations are still a risk, and Simon, as you just said, positioning could be a little bit of a headwind. How's the team taking all that information, I guess, synthesizing it, and what are our ultimate views at the end of the day?
Well, these views are on page 10. So if we can just flip to the next page, you'll see the synthesis and how do we combine everything together. To put things simply, basically, growth is good and potentially underrated, with the caveat of the potential impact of the lockdowns and curfews. Inflation is nowhere to be found. Inflation is not the issue now. Sentiment used to be, as you said, a tailwind, but no longer. Valuations are a potential risk. When combining all of that, in our view, that leads to 3 convictions that are currently driving our dynamic allocation. First, we have a positive view on equities for the growth and rates reason we just mentioned before. And we combine that with 2 other positions. The first element is an overweight for gold as a hedge against the uncertainty gathering around this quarter's sources of stress. Okay, we think gold is good as a way to hedge against uncertainty and this uncertainty could be key over Q4 as Simon mentioned. Second and third position, second element in this combinatory game is a long position for defensive forex crosses, such as a long yen versus Australian dollar. This pair has been working very well during periods of stress, essentially the periods of stress we've seen this year, and we think it's an interesting way to create asymmetry in our dynamic allocations performance should market go south, as it's the case today.
Thanks. All right. Thanks for summarizing that, Florian. Now, I'll just remind everyone, if you want to ask a question, please submit that in the text box in the top right of your screen. We'll have some responses for you towards the end of the presentation. But before we get to those questions, I just wanted to ask if either of you cared to comment on the impact of new COVID lockdowns that were recently imposed across Europe. Obviously, we've seen an uptick in new cases. I think we're all, sitting here wondering, is this going to be February all over again?
Yeah, you're spot on. I'm gonna answer that question, and I'm afraid it should be a lengthy answer given the significance of this issue now. So the question is, like you said, is it February all over again? FYI, we've put together our weekly macro reviews this week, especially dedicated to that question, in case the audience would be interested. And I'm just going to give you here a short summary. So. If we summarize things, growth is strong, the recovery is underway, while the growth rate of the pandemic accelerates. That, for sure, should remind investors of the February situation, where growth was also recovering from the 2018 slowdown. Data readings were also pointing to an improving situation, while cases were also spreading. Okay. Now, the issue we have today is that a W type of scenario in terms of growth would weigh heavily on consumption, investment, and eventually on earnings, on equities, and it has now become a major threat. Actually, it's a significant risk. We think it is essential to think of the current situation in terms of commonalities between February and today, and differences, and from that analysis to derive a market scenario. So, what are the commonalities? Just like what we said. Recovery period shaken by lockdowns, hampering consumption and investment, threatening earnings. That's what's clearly common between the two periods. Now, we also see two significant differences: good news, bad news. I'm going to start with bad news. Bad news: central banks and governments potentially have used already a large portion of their ammunition fighting wave one. So there is no less room for additional measure and less room for the strength of the positive surprise generated into markets by the strong and large action of our policymakers. That does not discard at all the fact that we all know both the fiscal and the monetary policy side of things will remain supportive for the economy and for markets. That's not the question. But the surprise element will be smaller now. Okay, we got used to being confronting with large fiscal stimulus and low rates periods overall. That's the bad news. The good news is that the surprise could be also limited from us with the pandemic situation. By that, what I mean is that first, we know better where to look in terms of data as investors. To track down what's happening on the macro front, the macroeconomic consequences of the lockdown. We on our side, for example, we use what we call newscasters, so real-time, high-frequency indicators based on media news flow to gauge the solidity of growth and the potential impact, actually, of all the measures taken to counteract the spreading of the pandemic. We also scrutinize what happens in terms of service sector versus manufacturing sector. We've learned to know it's a very important element. We also gauge what's happening in terms of geographical evolutions. All in all, we think that investors and us understand better where to look to track the macro situation. When in February we've been surprised and we've been actually missing ammunition to be able to track the phenomenon with precision. So that's the first element. Second element, authorities have learned also to better and faster react compared to the beginning of the year. Someone was referring to that previously. That should also limit the surprise of the public, the surprise of market, and that's a positive limitation of the surprise factor, I would say. And finally, last point. So the positioning in equities has been on the rise. That's for sure. Positioning is no longer a tailwind. But in the meantime, implied volatilities, they've remained high. And that shows, to a certain extent, the strong hedging demand from investors. So that element is very different from the February situation, where this level of hedging was much lower. And that should limit the scale of the portfolio deleveraging process that we could see if cases accelerate. Because basically investors will be better protected, and that will also have a more limited impact, we could say, on the systematic strategies that should react less violently. So when we combine everything together, growth could be indeed at risk. That's the first key conclusion from the current situation. Additional stimulation will be more marginal, will create less surprise than before, than what we've had in February, March. But on the other hand, authorities and markets have learned their lesson. That's a very important element, and they look a lot more prepared than before. So markets are at risk from that perspective, but potentially not as much as what we've seen in Q1. That's a very long answer to your short question, but that's a very important answer, we believe.
No, it's very thorough, Florian. Thank you for that. And thank you and Salman for, I guess, walking us through the previous slides. And we're going to open it up to some questions from the audience now. And while you're speaking, we actually had a couple come in. So the first one, I guess, goes back to, I call it the big elephant in the room or donkey, depending on your politics. But what's our thinking going into elections, and what are the risks?
Yeah, I'll take this one and give maybe Florian a bit of a break to get maybe have a drink of water. So I'd say over the past few weeks, our view of the U.S. election has shifted, where before we saw Biden likely being the winner and the U.S. Senate being a toss-up, to now we see Biden as being heavily favored and the U.S. Senate leaning towards Democratic control. We think overall such a result should be actually a positive catalyst for equity markets in the short term. And that's primarily because Democratic control of both the executive and legislative branch would mean significant stimulus soon after they come into office, and less volatile foreign and trade policies. Corporate tax rates are likely to go up in such a scenario, though not to their previous levels. Vice President Biden has made it pretty clear he's looking for tax rates somewhere in between current levels and the previous levels. And also, those corporate tax rates shouldn't immediately be the focus of the new administration, which will be on supporting job growth. In this situation, U.S. bonds could be at risk, given the size of the stimulus that we would expect. But as Florian was alluding to earlier, the Fed should be there to contain any significant pickup in yields. So such an outcome would, we think, favor a reflationary environment and perhaps a meaningful rotation out of the strong outperformers that we've seen post-COVID. So I'm thinking, growth companies, large cap stocks, tech stocks, et cetera, to some of the underperformers. So potentially value stocks, small caps, and financials. I think it's also important to note that market expectations may become excessive as we get closer and closer to election day. So, for example, betting markets recently had the probability of a democratically controlled Senate at over 70%, which to us seems high, too high, given that the results really will be decided by just a few close races. And so if sentiment for a Democratic clean sweep continues to rise and is too high ahead of November 3rd, markets could be at risk. If Republicans hold on to the Senate, and even if Biden wins the presidency, the likelihood of any major stimulus vanishes, and the market, at least right now, seems to be pricing in the opposite.
Thanks for that, Salman. And we're coming up on time here, so I'm just going to take, I think, one more question from the audience. And obviously, your response just then was very timely. So thanks for that. Thanks for that question, whoever sent that in. The next one is, why and how are you looking at currency markets to find opportunities in your dynamic allocation Salman, maybe I'll flip that one back to you. Care to elaborate?
Yeah, sure. I'll take this one, try to run through it quickly since I know we're up on time. So I think this is an important question in the current context. Bond yields are at such low levels. Gold prices have been bid up significantly. Florian mentioned VIX is elevated. So finding diversifiers to a pro-growth tilt is critical. And we think currencies can play this role. In terms of our views, I would say we see different cross currents for first the US dollar, depending upon your horizon. Longer term, there are key downward pressures on the dollar. Real rates aren't at a premium above their peers. The Fed is, there to continue making sure that money in the U.S. is cheap, and you have a secular trend away from dollar for foreign exchange reserves. But in the short term, the dollar remains a safe haven currency that we think will be bid if some of the risks that we've been talking so far about materialize. It's also important to note that dollar shorts are quite significant. So if those investors are cut their positions or forced to unwind, it could be a significant tailwind for the dollar. And just very quickly to hit on some of the particular crosses that we think are interesting, we like Asian currencies broadly, I'd say. So in particular, the Indian rupee, Chinese yuan, and Japanese yen. In the case of the rupee, even though COVID cases and tension with China are concerning, they're important supports for India. The current account's been recovering the last few quarters and is now in surplus. FDI has remained quite strong, and the Royal Bank of India has built significant reserves and is ready to defend the currency if necessary. For the Chinese yuan, obviously there's a trade risk I mentioned earlier, but it's very clear that the Chinese economy has shown one of the strongest macro recoveries of any country post-COVID lockdown. That should boost Chinese assets, and we think the currency as well. Finally, and I'll end here, we like the yen, especially against high beta currencies like the Aussie dollar, as Florian mentioned. That cross has been quite reactive to market turmoil while not being too costly. Indeed, our experience with the bet has been quite positive recently. It's offered a nice convex and defensive return profile.
Well, thanks for that, Simon. And actually, we've run up on time. So I actually want to thank all of our listeners from around the world for joining the webinar today, as well as our speakers, Florian and Simon, for those valuable insights. And I can actually see on our screen now that there were a handful of questions that we weren't able to get to. But rest assured, a member of our business development team is going to follow up to address it with you. We're also happy to share the slides that Florian and Simon spoke to today, if those are of interest. So thank you all once again for joining today's MiViews. I should also remind you that we'll be hosting these quarterly, so hope that we can all join together on the next go. Have a great rest of the day.
Thank you, everyone.
All right.
Bye-bye.